Hey guys, when you think about investing and using your money, and you're hearing all about these negative news stories that are going on right now in the world and in the media and so forth, have you ever thought that investing could be similar to a diet? That's what we're actually going to talk about today with André Stewart. He has basically an approach that is akin to a diet when it comes to investing in real estate or investing in general. So stay tuned and enjoy our conversation with André Stewart. Hello and welcome to another episode of the Ideal Investor Show. Today we have an awesome guest. Andrew Stewart is with us and we will talk about diets. You might be wondering why we're talking about diets when we normally talk about investing, but that's what we're going to do today, something a little different and not so different after all. Andrew, welcome.
Thank you. Thank you for having me on.
So tell me, what made you write the book?
You know what? With the real estate investing diet, I'll go ahead and say the name. I think I've been working in the industry for, didn't mean to, but I think because I've worked in the industry for a while and I've been kind of helping people out, a lot of my colleagues and my parents even told me you should, write a book, to pay it forward because so many people call asking for advice. And to me, it's like, how about I just put this in a book and give it to everyone? Because if everyone's asking the same questions, how about I just package it up and make it available so, it's easily accessible to anybody.
Right. And you said so much experience with working in real estate. Can you give us a little bit history, kind of your origin story? How did you end up getting into real estate and then ultimately into investing in real estate?
Well, I was a banker. I worked at Wells Fargo for a long time. So I started in banking right before the last collapse in '08. I literally got a job in December and then the market crashed in January. And I'm like, why did I get a job in the bank? But it was good that I got into, banking at that time because I learned so much about the economy and how market cycles and things like that. So, from 2008 all the way up until 2018, I went from Wachovia to Wells Fargo to a private bank, and then I ended up in Silicon Valley Bank as my last stop in banking. And so throughout that time frame, I moved from Florida to Los Angeles. And there's a huge cost of living difference. So I had to try to figure out how to just increase my income. And so working in banking, dealing with mortgages and doing mortgage loans, I kind of got a bit of an insight on what people were making who were working in real estate. And so it kind of intrigued me to learn more. So I kind of got into it from that point.
And so did you become an agent or what was your role after?
No, I actually, being that I was living in the South and I got into, bringing properties from the South to buyers in California because, if you had $70,000 or $80,000 here back in 2013 and 14, you can buy a really nice house in the Southeast or in like the Midwest. And $80,000 is not going to get you anything in California. So I started wholesaling properties to people when I started initially investing in real estate in 2014. And so from that point on, me being a wholesaler, I kind of started being like, you know what, instead of me, doing wholesaling, how about I start doing my own real estate deals? So I started flipping gradually from wholesaling to flipping my own properties.
Okay. And so then you were in Los Angeles, as you said. How do you flip properties from Los Angeles?
Well, I don't. It's funny because every single property I've ever flipped has been remote. And so, my thought process was like, you know what, instead of me spending $300,000 on a little rinky-dink home, 2-bedroom, no bathroom in Los Angeles, I can take $300,000 and buy 5 houses. And so that's kind of what I did. So I didn't become an agent. One of my friends who I got into real estate investing, he became an agent and I became an investor. So we just had this plan to where, how about you become an agent and I stay on the investing side? And so that's kind of what we did. And so he was one of my main connections with getting properties in Georgia to invest in.
Cool. And so let's just maybe use an example. Let's say you find a nice, like 3-bedroom, 2-bath house and a little bit of garden around it and stuff like that needs work. And you're in LA, but the house is in Georgia. Did you just have people that you knew from before that would basically oversee any kind of renovations and fixing, or how did that work?
It's interesting. I've had some interesting stories building my team. So what I did was I built a team over time. Like there's 2 scenarios that I had to bail my contractor out of jail. Like they build my team for me to get there. So my first 2 contractors that I were introduced to, You mean they end up going to jail? And I'm like, what am I going to do? So I had to bail them out because I didn't have any other contractors to finish the job. So from that experience, I just end up going through millions of contractors. I went through so many, at least 20, before I finally got to the right, group of contractors. And so then from that point, I would just use that. So what I did was basically I built a team of contractors in Augusta, Georgia, where I flipped, a lot of properties. And so that's what, helped me invest from here in a place like that. Cause I had my friend who's an agent who was there. And then I had this contracting crew that was there. They were my boots on the ground, essentially.
Okay, cool. And you said are they still doing that for you, or have you stopped doing that?
No, I still do it. I ended up going from Augusta to South Carolina to we doing a property in Maryland, Vegas. It just kind of went all over the place. So from that, the only thing I did was basically recreate what I did in Augusta and do it in other markets. So essentially, when you get into any new market, you're gonna have hiccups. When I got to Vegas, the first contractor gave him $10,000 and he disappeared 3 days later. So it just happens like that. Same thing in South Carolina. Gave the guy $10,000. He disappeared, but eventually you start building out teams, and if that team can't do it, then you don't need to do that deal.
Right, understood. Now, I think this brings up a really interesting dynamic, and contractor is probably, if I'm not misunderstanding it, you're using that as a pretty broad term, because I'm sure it's not just one
Correct.
contractor that is renovating a property. Now, I'm always interested in the human dynamics, and before we talk a little bit about the diet and how the book helps and stuff, what do you think is the reasoning that these things, like you were just describing them, occur? I mean, you are a guy who wants to actually make a deal work. You would think the other people on the other end that you are actually giving the opportunity would have a similar interest. So in your opinion, what do you think is the reasoning for these kind of experiences that you just described?
You know what? From what I noticed in each of these different markets, a lot of times the contractors are like handymen. So they don't really have a particular background that you might think. So they're used to doing odd jobs. And so when you give someone a lump sum of money sometimes, which is 10,000 up front, a lot of times they take that 10,000 and they live off it for a while. From my experience, in addition to that, I also think that contractors over accept jobs. So you might have a contractor who's working on 3 projects at one time. So he's giving more attention to this one particular job. And a lot of times he might run out of funds on that house. So then he'll take the funds from your house to work on that house. So sometimes either they don't have a particular background that constitutes consistency. So they end up taking the money and going and doing something else with it. Or they just get overextended on having too many projects and they use your money and then eventually they disappear because now they don't have the money to finish your job. And so I think that's what happens with, and like you said, I generalize contractors, plumbers. It's kind of all the way across the board, but generally plumbers, they do their job. Electricians, hit or miss, but general contractors, the ones that are doing the most of the work, those are the ones you really have a hard time with.
Okay, understood. Now, how much do you believe does it make a difference when they know that you are quite far away versus like the next town over?
Mm-hmm. It's funny because I've done this for a while, so and I've helped other people, and I help people do it right now. So the people that I've helped, eventually I let them use my team, and then they get the process down, and then I let them go off and do their own thing. And I think what you find out is that it's kind of hard to say. I think people that you're working with, if you don't establish that relationship from the beginning, and they just know you're bringing money, I think they do take advantage. And so if you don't have a person going by the job all the time checking in, they just like, he's not even here. And so one particular person that I did help last year, he went off on his own and he was just giving the contractors $40,000 up front, which is a horrible idea. And they knew he wasn't there. And so they would just send him pictures of random projects they were working on that wasn't his house, telling him it was done. And then, he just went over there unannounced and his house had not even been touched. That's why I think it's important to have an agent or a crew that you have built a relationship with, because they're not going to take advantage of you.
Okay, yeah, that totally makes sense. Now, one thing that I'm a little bit curious about in this context, and maybe I should rephrase that for any new listeners who hear us for the first time talking about this. In Ideal Wealth Growers world, what we basically do pretty much exclusively is working with turnkey providers, and specifically turnkey providers who find the property, renovate the property, sell the property for an appraised price that a bank is willing to finance, and then also manage it. Now, from the industry, that's not every turnkey provider. A lot of them do only parts of that, but we're only working and recommending those that do all these things that I just mentioned. But what I'm being accused mainly by other people in the industry quite regularly, even to this day, is that by working with turnkey providers, I'm supposedly overpaying. And now here you are as an expert who is not working with turnkey providers, but working with contractors and crews and teams. How much do you think is that a valid argument, or how much is it a balancing act between, okay, yes, it might be a little more expensive to work with a turnkey provider, but it's all on their shoulders until closing, right? And not really on me, because if they don't have a property that appraises, then I'm not going to buy it.
You know what? There's two ways that I look at that. So, just from my experience, I do that. If someone comes to me and they say, "Hey, I want to get into real estate investing," I will use my team and do the entire transaction from start to finish for a fee, right? So I will essentially take a house and make it turnkey. That's a little bit different from trying to buy a house that's already turnkey because the profit's already been built in and you don't know the cost that has been spent. And they could have overspent to get that house to where it is. So you kind of potentially can overspend if you're getting into a house that you don't know the exact background on. But essentially, I think that depends on the type of person it is. Like if you're a person that's super busy and you don't want to deal with the stress of going through the process of a flip that's 30 to 90 days or maybe even longer, and you just want to go ahead and get a property that's already turnkey that you know is going to do well and it's going to cash flow. So I think it depends on what that person is looking for. But in my opinion, I think if you can, work with someone to do the entire process from start to finish and then take over that property, you would get the increase of equity from the, forced equity, which you do in the rehab. And then if you take that property and turn around and refinance it or whatever the case, then you get that capital gains out of the way because, if you do a refinance, it's tax free. So I think it all depends on the person and the timeline that they have. So, but I do think you can overpay because, those people that do turnkey properties have to have their fee built in to making that property turnkey.
Yeah, absolutely. And I think you described that very well. So I would say, and I think we're pretty much aligned, if somebody, and our clients, I would submit, mostly look for, I have a full-time job, I have a family, I have all kinds of things going on, but I want to do investing in residential real estate, and I don't want to pay like the 300,000 for the 2-bedroom, 0 bath, right?
Correct.
So then how can I do this with some assurance that I get a product that is worth the money that I'm putting in? And turnkey providers, as you just mentioned, yes, they make their profit, and anybody who does the work, I think, is entitled to get the profit. But the safeguard is, for one, obviously from the county records what the original purchase price was for the turnkey provider. You have the statement of work. And most importantly, the agreement, the contract is always, you tell me when you're done, I send you the inspector and the appraiser, and if they don't get to the number that you're asking, you don't have a deal, right? So the property needs to be inspected and appraised, and obviously financing doesn't work if it doesn't appraise to the price that they're asking. So there are these kind of safeguards in place, but you're right, the equity gain, or whatever other term you want to use, that you could make if you did it all by yourself, you're giving basically to the turnkey provider. On the other hand, you're not losing 10,000 here or 10,000 there for people that run away, because there is no deal until it's inspected and appraised, right? So those are two of the differences. Now, you said one of the things that could be interesting to talk about, and I think it's super interesting too, because I think we both in the industry and constantly have an eye on the pulse, is things have really changed a lot this year, or maybe you could say in the last 12 months, right? Like if you go back to like early October 2021, interest rates were still low, prices were significantly increasing, rents were just starting to come up to where we are now. So I'm really curious, and I'm sure our audience is curious, what's your take on the situation where we are, and maybe also a little bit what you're expecting going forward, how things will develop?
Like you said, you hit it on the head. The last 12 months have been very interesting. A lot of people made money in the past 2 years, But this last year, a lot of people have lost money. And I think that trend's only going to continue, especially if you bought a house in the last year. I remember, for example, a house that I was going to get. It was in Arizona. I looked at the house. The house was 168,000 in November of 2021. I looked at the house in June of 2022, and it was $360,000 or 330. Nonetheless, the house went up like 140% in 7 months. And so people were buying the houses. People had this fear of, missing out during that time frame, and they bought a lot of houses. But now you see that this correction is fierce, and it's going to only continue because they're going to keep raising rates because they have no choice. They may come to a pause maybe in the first part of next year, but the house prices still have to come down to keep up with inflation and things like that. People just can't afford to buy a house with rates being what they are, in addition to the cost being 60 or 70% more than it should be. So we know that the housing market is going to correct. I do see, like a lot of people see, what's going to happen is going to be similar to 2008. I think people are looking for a collapse like the stock market did in 2020 in the housing market, which doesn't happen like that. So if you go back to 2008, that collapse went from 2008 all the way to 2012 before we got to the bottom of the real estate market. I think we're going to do it again. I think we're going to have the same thing happen, and it's going to be a 2 or 3 year time span before prices come back. I don't know if they're going to go back to, houses went from 200,000 to 50,000 in that time frame, but I do think we're going to see a correction, and that's all across the board. That's global, and I think the trend is people are going to start getting out of I would say the U.S. and investing remotely. I think that's what people should do, is because if we're going through a currency crisis as well. So right now the dollar is very strong, and if people are smart, if you're in the U.S. and you take that money and you invest it in somewhere like, an emerging market like Colombia or somewhere else, once this turns around, their dollar is going to appreciate against the dollar because the dollar is going to collapse. So your property value is going to flip flop. So in turn, you're going to get it for cheap now. But once that currency turns around, if it goes the way that I think it's going to go, then that property is going to be worth more in that other country and you got it for less.
Yeah, absolutely. That's a great point. Now, that's one aspect is price. And I agree with you. I don't think it's going to go down a huge amount because, it's a matter of definition. How much is a huge amount? I would think no more than 20% from the highs. And the main reason why I'm saying that is because I believe the biggest mistake, if we even want to talk mistakes, that happened between 2012 and 2022, basically those 10 years, even though interest rates were like extremely low, like lower than they've ever been, for all kinds of reasons, fear, banks, new rules, all kinds of stuff, there wasn't really anything done that I could see that closed this gap in inventory lag that we have. Right. I believe, and numbers are different and different people have different numbers, but I think we're probably 8 to 10 million units short right now. I believe there is a interest in getting into real estate for people who want to actually move in, buy something, move in and live there. And there's just not enough there. Now, you pointed out how much prices have increased. And if they came back 20, 30, 40%, it would open up for a bunch of more people again. But the main point that I see is, as soon as people see prices coming down, there will be a growing number of relatively well-earning people to say, okay, now I can get in, even though interest rates are higher than they used to be. So I don't really see this kind of capitulation that some people seem to be waiting for. But obviously, I agree with you. Now, the other part that we didn't touch on, when you talk investing, our approach is focus on cash flow. Other people's approach is to say, I buy something for a good price, a reasonable price, then I put some money in to bring it up to market value and renovate it and stuff. And then I can sell it for a higher price and I make a profit. Whereas we, with our cash flow investing, it doesn't really matter. If it cash flows on day one, it will always cash flow. I don't care what the price is really, or what the price is after I bought it. If it goes up or down, it's fine. It doesn't really matter. But what's your thinking about, we have had a crazy, for me, I've never seen anything like it, a crazy growth in interest rates. What do you think? Are we done, or is it going to keep going? Are we going to see 2 double-digit interest rates for mortgages, or where are we heading?
Well, to piggyback off what you were saying, most people buy properties based off of the monthly payment. You know what I
Right.
mean? And that's people's barometers. Like, you know what? Can I afford it? And they base it off of that. They don't base it off the number that you're saying, because if they based it purely off cash flow, then it wouldn't matter because they can hold on to this property. They're going to keep it for a while. So even if these prices go down, I've said this before, if they go down 40 or 50%, but if you plan on keeping the house for 10 or 15 years because you're getting
Yeah.
cash flow, it doesn't matter, right? You could get it
Right.
cheaper, but hey, if the rate go down in 7 or 8 months and you're already cash flowing and it's paying off the mortgage now, refinance when the rates go down and it's just going to increase your cash flow. But people don't really typically buy based on that. What you're saying is true. I do think that, as far as the interest rate go, inflation is going to be here. It's not going anywhere. And the velocity of money is starting to increase as well, which I don't know if people are paying attention to that. Like before it was going sideways for a while, it took a dip and now it's trending upwards. If velocity of money picks up, that's going to obviously increase inflation more than it is right now. So I do see them raising rates maybe 2 or 3 more times, if that. But then they're going to have to reverse course because the economy is doing so bad. So to prevent us from going into a depression, I think they're going to have to drop rates to get some money back into the market. And the biggest way to do that is through mortgages and lending. And so I think they're going to have to reverse course sooner rather than later, unless they're really just trying to collapse the market and start this thing all over again. I don't know.
Yeah, right. Now, when you say sooner rather than later, how soon do you think?
It's looking bad right now, and the economy has a lag. So I keep saying the first quarter of next year. I think by March they're going to reverse course. They're going to lower rates because the economy is really bad. And so if they reverse rates in March, we're not going to feel that until the summertime of next
Yeah,
year. So
right.
ideally, I think that's when they do it because if there's a 3 month lag, yeah,
Right, yeah, exactly. Well, and then the issue is not to underestimate. I believe it's important for our audience also to differentiate between somebody who wants to invest in real estate and somebody who wants to live in real estate, right? Like an
correct.
owner occupant. Because from an investor perspective, you're very right. And like I keep always saying, if you buy something that cash flows from day one, it doesn't matter how much you bought it for, and it doesn't
Doesn't
matter
matter.
what the interest rate is. That's the one thing, and it can get better or worse as far as prices and interest rates are. But if you cash flow, you cash flow. And then also, I think what is forgotten in the media oftentimes, or just they ignore it, is all these people that either bought something, invested into something, or refinanced. They refinanced in the 2 to 3 investment financing, maybe up to 4%. But they didn't just do this for
Hmm.
2 years. They did that typically. Almost everybody I know did at least 15 years or 30-year mortgages. So right
Yep.
now you're sitting there and you're saying, okay, there are the first signs of 7% interest. Who cares? I'm not going to get out of my current mortgage when I have 2.8% or 3.5% or something like that on it, right? So that aspect, I think, is kind of hidden a little bit. But what I'm kind of thinking about, even if there were this reversal, I think the overall issue is by the time the reversal is coming, the employment situation is probably going to change dramatically. So people who are currently thinking, okay, we have 2 incomes, we have a relatively good job, and if the market were ever ready for us, we could step in now. Well, you don't know if both of them will continue to have a job in 6 months from now, right? And so this affordability aspect, I think, is a really, really important pivot point to keep in mind, right? Like if you can afford it now, and it's dependent on 2 incomes, you constantly have to ask yourself, even if interest rates start coming down a little bit, is that still true? And the same with prices. If prices come down 20%, that's still not anywhere close to what it was 3 years ago.
That's what I think what you're saying is true. That's what I think is going to cause the collapse. I think the employment situation is going to cause the major problem because people are just not going to be able to afford to pay their mortgage if inflation keeps ticking up and someone loses their job, right? So that's going to be an issue with, them being able to save the market. I think the housing market is going to collapse because of that reason right there. Unemployment is going to tick up and then people just might not be able to afford their current house. And that's what I think is going to happen.
Yeah, I agree to the extent that I would say for anybody who bought something, let's say in the last 9 months, I would agree with that.
Correct.
But people who bought in 2020 or 2021, they got it for quote unquote comparatively cheap. Both the prices were not
Correct.
as massively inflated and the interest rates were extremely low. So instead of having like a 45% debt to income ratio, they were probably more in the 35 or 30% area, right? And even though somebody might lose a job or prices in inflation go up, I think they're not tapping out quite as quickly. Now, the most recent people that most recently bought, they are kind of like on the knife's edge, so to speak, if they can actually hang on and handle it or not, right? So especially if somebody buys now to own or occupy, that is really, I think, pretty risky. With that being said, I don't want to really have our conversation end without you telling us a little bit about the diet and the book. And what is the diet, actually?
You know what? The premise of the book called The Diet, I love working out. And so I just feel like everyone at some point in time has tried some sort of diet. And with any diet, the principles are generally pretty easy to follow if the plan's there, right? Just read the paper. It tells you what to do, or read whatever the plan is. And so I basically just simplified real estate investing to where you would do any diet. So that there's calendars, there's a plan, there's every single thing you need to do like you would have on any meal plan, but it's just real estate investing. So if you're going to have a diet for your health, you need to have a diet for your financial picture as well. And so I kind of just wrapped that in and made it super easy for anyone. Doesn't matter your education level or anything. If you can do a diet for food, you can do a real estate investing diet.
Okay, very cool. And so obviously we want people to read the book, but can you give us a quick little summary? What are the main components, what to do and what to avoid maybe in the investing diet?
I think the thing, especially right now, is the mindset. Yourself, real estate investing is about a mindset. And when you get into real estate investing, you might not get a deal for the first 2 years. And so in the book, I outline the mindset you must have. I outline accountability because both of those are huge with real estate investing. And then I also broke down people's limiting beliefs. A lot of times people don't become investors or get into, any kind of stock or real estate investing because they don't think they can, or they think only rich people do this, or they have all these limiting beliefs that they got from their childhood or their upbringing or their surroundings or environment that prevent them from even starting. So I tackle that. In addition to that, I talk about different financing and acquiring and exit strategies that you can do. So you kind of have everything you need to become an investor, from the way you need to think. I even give marketing tips on what you should do. I give basically, how many hours you should spend on podcasts, how many hours you should spend on looking up. I do everything. So it kind of covers everything.
Wow, that's cool. And I think anybody who has ever tried a diet of any kind, there's always the big picture thing, I remember there were diets for health where people said avoid all cholesterol. Another diet says avoid all sugar, or, things like that. And then when you actually get into it and you start digging deeper, then there are way, way more details to pay attention to, but they're all in support of the diet. They're not in addition to, they're basically just supporting the fundamental premise. And I totally agree with you, that mindset. I actually even wrote something called the Mindset Manual that people can download in our website, because I agree with you how important that approach is. So I think we covered that part, and we are almost out of time for today. But I always, every podcast we do, I always ask the same question at the end. And it has very little to nothing to do fundamentally with real estate investing. And that is, if you had a time machine, you could go forward, backwards, anywhere you want. You can be there. You know everything you know now. The only thing you're not allowed to do is change the time-space continuum like Star Trek, right? So you have to keep that. You can't just play the lottery numbers or something like that. But if you had that option to go anywhere, forward or backward, where would you go and why?
You know what? Based on everything going on in the economy, I wish I can go two places. I wish I can go back to the 1920s to 30s, right? Because I think what's going on right now is very parallel to what happened back then with the stock market, with everything, the economy, the whole thing, even with wars. And then, so I would want to go. I would want to go there first, and then go 5 years from now to see if what I'm thinking or what I've been saying plays out the way I think it's going to play out. Because then, like you said, with the knowledge we have now and that we've talked about, it'd be great to see how this unfolds over the next couple of years.
Yeah, absolutely. I think that's awesome. And when you do that, I want you to stop by with me again, because I'm really curious. The way it's always been portrayed, the 1920s, the Great Depression kind of thing, this whole bank run thing that everybody in the media and the historians talk about, is always described as if it happened out of nowhere. right? Like people were sitting at home having lunch or dinner or whatever, and then some trigger happened, and they all started running to the bank and
And it just
wanted to
got
take
out.
their money, right? Like, and I have a strong suspicion that's not really how it was. So when you go there and figure out what was really going
I'll let
on,
you know.
yeah. Well, and I think everybody would be interested, and I totally agree with you, Andre, that I think there are very
Mhm.
similar things, and even in some way worse things, because they didn't
Correct.
have more than 100% debt on their
That's
GDP when they started, right? So we
correct.
have maybe more instruments and more media and a few more tools, but I'm not so sure that our situation isn't potentially worse. The one thing that I believe might save us, or at least not make it worse than it was then, is that we're more connected, right? Like the Great Depression basically happened in a relatively limited number of places in the world and not the whole globe. And nowadays we can basically balance it out a little bit because we always in our media, that's one thing I'm complaining about. We're pretending that there is no other place in the world than the United States, right? But there's a huge globe and there's stuff going on.
So true.
And well, and it's a globe, but there are places in the world that are actually thriving, even right now.
To piggyback off what you said, the reason why I think this one is going to be worse, because for one, the GDP, the debt to GDP is like 127 or 30%. So it's way
Yeah.
higher than it was back then. But I think I think social media, because everyone's so connected, if anything goes viral, it's going viral all over the world. And so that's what I think is going to be different, because back then you had to read the newspaper, talk to a friend if you had a phone, but this is going to be completely different. So you're right. I think this time is probably going to be
Yeah,
a lot worse than
yes and
last
no.
time.
I think you're right about the information flowing everywhere almost instantaneously. But I mean, I'm very connected with my friends and colleagues in Europe, and
Mhm.
their information comes to us as fast as our information goes to them. But I've rarely ever
Correct.
seen anybody here really reacting to like take the most recent thing, right? Like the Brits seem to have kind of parked their brain somewhere in some place and forgot about it. Right? And if you think about what
Yeah.
they've done with their new prime minister, the tax thing, the Bank of England thing and stuff, you
The
would say,
bond
okay,
market.
are these really adults or what? Right? And we obviously heard about it literally hours after it happened. And there was a little bit of a reaction in the stock market, which I'm still not really sure it had anything much to do with the Brits. But yes, we knew about it, but I'm not aware of any investor who changed anything because the Brits went crazy. And the same is true, by the way, the other way around, right? Like I have a lot of friends who are investing in Europe, especially in Germany, and their interest rates, for example, for mortgages are between 1.5 and 3% right now, not 6 to 7% like ours. They hear
Mm.
every moment the Fed does something, they hear that almost instantaneous. But their decisions on how they invest and
Hmm.
what they do with their money versus what we do and have to do is not directly influenced. So this kind of fear of missing out or fear of doing something that the Americans do, we should do it too. Not 100% sure about that, but one thing is definitely
Mm.
true, that things, and that's what I mean, right? Like we know about it, but we also recognize the influences, right? Like the European
Hmm.
Central Bank cannot keep interest rates negative when ours is at 3%. It just, they know the money will all flow
Correct.
out of the euro and into the dollar, which is part of the reason why it's so strong, because you get money for it
Correct.
if you put your money into it, right? So they have to kind of do something to balance things out. Will it be enough? I don't know. I think nobody really knows. The one thing that I know, and I think you and I basically agree, if you find a deal where you get positive outcome continuously out of the deal, it's a good deal, right? Whether you get the
Correct.
positive
Yep.
outcome by buying cheap and selling high, or you get, like in our case, positive outcome by buying a good deal that cash flows from day one, as long as it works out that way, then real estate is a good place to be and will forever be, because people will always need shelter.
Everyone's going to need somewhere to stay. And then, like you said, it's assets, right? Assets tend to go up in value, but a house is, historically, even if it dropped, it has always came back and it always exceeded whatever that previous high was. So, like you said,
Yeah,
real
and
estate is probably the
actually,
best
I
thing to
mean,
get into.
I'm giving you one perspective that I've been using lately when my clients ask me something, and feel free to clone it, let's call it. And that's I'm telling people, if you think about it, you find a house 5 years ago for $200,000, and you go look again, you went to sleep and you came back and you now look, and it is right now, it's $500,000, like you said. It's not really that living or staying in this house provides more service. The house is still 4-bedroom, 2-bath. It still has the same garden. It still has the same roof. One of the really biggest things that people always, I believe, forget is that a significant part is that our dollars are just not worth as much. So you need more of those dollars
Exactly.
to get
That's
the same service out of it. That's also why in very, very rare cases that almost nobody can point to, would you ever get a situation where you can actually buy less. You can buy less when it's foreclosure. But under normal circumstances on the normal market, it's very rare because our money constantly, like right now, 8.5% every year is losing its value. So if you say, okay, well, how is it then that somebody bought a place for 100,000 that's now 500,000? It's not really the value of living in that same exact address has changed so much. It's that the money that you need to bring to the table to exchange that value for, to be able to live in that place, in that same place, that money is worth, well, I had a word in mind, but
So
it's
much
not
less.
worth much anyway. So it's not really buying you the same thing. And that's true for gas, it's true for food, and it's also true for houses in that sense. Now, I want to give people an opportunity to get access to you and your diet. So what do people need to do if they want to talk to André?
You know what? They can go to AndreStewartAuthor.com, and that kind of has my social media handles. I mean, it has all of my stuff on there. I'm on Twitter sometimes. I'm not really a social media person. Or they can always just reach out. If they want to reach out directly, they can just email info@investfar.com, and I'll respond. But AndreStewartAuthor.com has the book. Amazon has the book. It's kind of everywhere. It's nationwide. So
yeah, that's very good. And obviously, we're going to put both the website and your direct email and stuff in the show notes. So everybody who is actually seeing this, hopefully everybody giving comments on how much you liked the discussion with André, and you find the links to get in touch with him. Yes. So André, thank you so much for being on the show. And I hope a lot of people are going to take the diet.
I hope so too, especially in this time.
Yeah, exactly. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.